Yeah, you're welcome to this discussion session to address some of the questions you sent to me. Some of the questions actually relate to the meaning of investment and investment management, investment vehicles, the investment process, classification of investors based on their characteristics, the investment policy, investment manager appraisal, uh, and other issues such as the investment environment. We are also going to deal with issues relating to recent development in investments. Um, yeah, the point is, what is investment? What is investment really about? Is it just about the continuous process or the ongoing process of committing current resources, your current money or capital and or other resources in the expectation of reaping future benefits? And the future benefits derived are usually compensation for the risk taking and the length of time in which the investment is held. We trying to say that investment should be considered as a continuous process. We're not talking about those who just make a one-time commitment of funds into a particular investment vehicle over a period of time and that's the end. But we are looking at investment as an ongoing process, a continuous process of committing your current resources into a particular investment vehicle. And these investment vehicles only refer to the available instrument that you make the investment, such as if you consider the capital market, we're talking about bonds, you're talking about stock investment, etc. If you come to the money market, you're talking about bills, government bills such as treasury bill, and or other instrument of short-term duration. Basically, these are the investment vehicle. Well, it is also important that when we're discussing investment, we do not focus only on the financial instrument. We also need to look at the available business opportunity, available real sector investment activities, such that uh, we need to also consider setting up a tabletop business as an investment. We need to consider trying to set up a new business as part of investment. So in this case, our investment vehicle is both financial instrument and real sector uh, economic activities. And the investment actually is held over a period of time. That period of time that the investment is held until you begin to reap your benefit, that period is the maturity period. So the investment is held over a certain period. The period in which you hold your investment is normally referred to as the holding period. And the holding period may not necessarily be the same as the maturity period because the maturity period for your investment may be 5 years, for example, but you may decide to hold the investment for 2 years and disinvest or sell off your investment to another person and for you to exit from that investment process. So you are able to hold the investment for just 2 years. So the 2 years become your holding period. But if you're able to hold the investment up to maturity, then your holding period is the same as the maturity period. So these are basic things that we need to appreciate as we go along. But there are other important things that I believe we need to look at. Financial instruments are very important to us because they are easily divisible, we have a lot of information available surrounding financial instrument. If you take a capital market, for example, on weekdays, almost all the time, you read the newspapers, you listen to news, their business news. They try to, as much as possible to give information about the capital market activity, price development, volume of trade, etc. So there is much more information about financial instrument in general, as opposed to real sector activities. So I think those are the things that I believe we need to be thinking about as we look at the investment vehicles. So we have so many investment vehicles around us we can choose from. When we go to the theoretical areas, we may be assuming that in an investment space, there are millions of investment assets or investment vehicles that we can choose from, and we'll be comparing the benefit we derive from investing in uh, treasury bill as considered as a risk-free instrument, and compare that with investment in other instruments which we classify as risky instrument. However, the degree of riskiness for a particular risky asset differ from one asset to another. So real assets, which are generally physical assets, are also considered as part of the portfolio of investment assets that are available for investors. They may include investment in commodities, real estate, uh, purchase of land, keeping it over a period of time to appreciate in price for you to sell, purchase of equipment for productive activities to generate revenue, investment in natural resources, etc. And as I said, from the perspective of micro to small scale business dimension, setting up a small tabletop business is also an investment in real sector activities. Except that we can compare the liquidity of investment in financial asset and real asset. Normally, we believe that financial assets have much more liquidity as compared to real sector activities because of the easy change of ownership from time to time. When we are especially trading on the stock market, you have ability to discount your bills, etc., to get your money. Uh, but when we come to real sector activities, sometimes these things become difficult. But it does not mean that they don't possess liquidity. It does not mean that you will not have people to sell to from time to time. But when you compare to financial assets seem to have more liquidity than real assets. But in all these things that we are discussing, it is very important to try to look at investment from policy dimension. Uh, it is appropriate for for investment to be guided by a written document that contain objectives of an investor, the return expectation, the risk expectation, and even uh, the means or the a way of constructing portfolio. Whether the investor is interested in constructing portfolio based on location or based on geography. In that case, if you want to construct your portfolio, are you interested in constructing your portfolio part in your country and part outside your country? Even if you want to construct your portfolio within your country, uh, is it possible that you are trying to focus on regions, or you are trying to focus on only certain districts for your investment to take place? That will be describing your portfolio construction based on geography or based on location. Those things will be very clear. Is he an investor who is interested or is guided by his faith? So that we are talking about faith-based investment portfolio construction, or is it an investment who doesn't actually care about whether it is faith-based instrument or not? Is he an investor such as people who believe in Islamic faith, who believe in Islamic financial system, who do not want to put their money in investment avenues such like gambling and the rest? All those things will have to be described in a policy document to guide the investor or to guide his investment manager or his portfolio manager. The philosophy of the investor or the philosophy of the investment ought to be clearly documented to guide the investment process or the entire investment activity. So that is very, very important. We have some investors who are interested in sustainable issues. Green investors are there who do not want to invest in anything at all. They are conscious about the investment in area that will not be that will not cause damage to the environment, that will not cause damage to human life. Uh, People are interested in businesses that will actually not undermine the the human rights of other human beings. So all those things will have to be captured and guide the investment manager. If that is not done, it limits some of the responsibility that the investment manager is supposed to take. So that document is what we're referring to as the investment policy. So it is very important that investment accompanies or is accompanied by investment policy or is guided by investment policy. So the investment policy actually guides the investment process. It defines the investor characteristics, the risk return expectation of the investor. It actually defines the investor philosophy and the objective of the investor. Uh, People actually talk about three important categories of objective for the investor. Some people talk about investing to generate revenue, investing to protect your capital, or you trying to invest to have some appreciation in your capital, or your investment is just a means of keeping your investment, so we call it capital preservation. So we need to see clear what is the investment philosophy, what is the investor objective in terms of investment, and all those things will guide the risk return expectation. If the person is just interested in preserving the capital, the other person may not be interested in how much interest rate is available for fixed income securities, how much return he will be getting, but he's just interested in ensuring that that capital is preserved over a period of time. But some also invest just to generate some gains, and some invest because they want to use that investment proceed as means of income generation for their consumption. So they invest, they take the proceed for their consumption and continue to invest uh, all the principal plus part of the return or the interest, and or they will consume all the interest and invest only in the principal. So we also need to look at the investment constraint or the restraint that the investment policy will pose on the investor or the investment manager, portfolio choices, uh, and the type of investment manager that the investor may want. All those things will have to be clearly put into the investment policy. So it is proper that this document is available to guide the investment manager. Because the investment managers are supposed to implement the investor's investment policy on his behalf. So if it is not available, it will be the discretion of the investment manager. And some of the discretion may not go down well with the investment orientation and investment philosophy and objective of the investor. So to avoid all that, it is proper to have an investment policy. So an investment policy statement should have four main components as identified by the Kane and Marcus in their book written and published in 2011. And these are one, the scope and the purpose of the investment. So any investment policy that you see, these four characteristics are important. That is the scope of the investment and then the purpose of the investment. Is the investor investing because the investor want to earn income? Is the investor investing because the investor expects that at a future date he will gain more than he put into the investment vehicle? So the purpose is very clear, should be very clear. And the scope, what should it cover? Will it cover a combination of fixed income instrument and equity instrument? Will it be concentrated in one industry, or it should cut across industry? Will it be international portfolio, or it should just be domestic portfolio? So all those things will have to be clearly defined within the scope of the investment. Then the governance is also very important. What are the rules to follow? So that define the governance that the investor will have to indicate. So is the investor setting out rules as to which investment vehicle to follow, or the investor is having a rule to allow you to actually move from one asset class to another asset class? Investment return and risk objectives will have to be very clear. It should be very clear whether we are dealing with a risk averse investor or risk neutral investor or an indifferent investor. It should be very, very clear about that, whether we are dealing with a passive investor or not. Then the investment policy should have an infusion of risk management tools. The concern for risk management should be very clearly defined and positioned in the investment policy. So we can now see that the investment policy is an important document. It has legal implication because, number one, the investment manager will have to be guided by the investment policy. If he does something outside the investment policy without the knowledge of the investor, that can create some dispute between him and the investor, especially when action taken outside the investment policy erode the investment of the investor. So it has legal implication. It brings about efficiency in asset allocation and asset choices. So it actually provides the conduit through which the investment manager will be guided and focused on risk management on behalf of the investor. So that is why the investment policy is a crucial document. And this investment policy is not only for the private individual who is making investment, or an angel investor, or a high net worth individual who is making investment. It cut across for businesses who are making investment in the form of expansion, in the form of putting some part of their funds into an investment vehicle. In fact, in some of the institutions, their investment policy clearly defines what percentage of their capital or their total funds that should be allocated to a single investment asset as they do the investment. So it's not just about an individual private investor, but it affects institutions, it affects corporate entities, and it affects individuals. It affects government institutions. It is very clear that in government institutions, there are processes to follow to invest. That is part of the investment process. In fact, if you take uh, the Petroleum Revenue Management Act, you will also see clearly that the investment policy that should guide the investment of petroleum funds have been clearly defined in the act. That tells you that investment policy is very important not only for individuals but also for institutions and the management of public funds. So we now want to quickly look at some basic explanation about the investment process. The investment must go through a process. Yes, we define investment loosely to mean the continual process of putting current resources into identifiable or particular or specific investment vehicle over a period of time that provide an expectation dimension to investment. Expectation is the key driving force in investment. You invest, you expect that at the future date you get more. But that investment must follow a process, must go through a process. And the first process is to identify the investor characteristics. What is the characteristics of this investor? Is it risk averse investor? Who will take higher risk because he believes that he's going to get higher returns to compensate for the extra risk that he is taking against the average risk that is being taken. So that ought to be known. So the investor characteristics in terms of risk, in terms of objective, in terms of philosophy, in terms of return expectation. All those things are very important. So that is the beginning of the investment process. Then you follow by the investment vehicle identification and selection. You need to be aware of the investment vehicles which are available and which one you prefer to choose and based on what. So that will go into a form of the construction of portfolio of the investor based on the available investment vehicle, the asset to invest in the economy, in the market that the investor choose to operate in. So that is the next thing that ought to be done. So you identify the investment vehicles and you select the investment vehicle based on the criteria that the investor is using or the investment manager is using. Then we also look at investment strategy formulation. Having identified the investment vehicle and selection being done, what is the next step? The next step is to design or formulate the investment strategy, and that investment strategy formulation is very important. It's important because you will now define what percentage of the capital available should go to asset A, go to asset B, asset C, asset D, depending on the number of assets that you put in your portfolio. This is very important, and that will define the weight of the investment. The weight of investment over here only means what proportion of the capital is actually invested in a particular investment vehicle. The higher the weight of investment, the higher the amount of money you commit to that particular investment vehicle. While doing that, having done the investment strategy formulation, then you now actually do the investment strategy implementation. So you have chosen your investment vehicles, you have assigned weight to the investment in terms of how much capital you are putting into a particular investment vehicle. Then you now do the actual commitment of the funds into those vehicles. So you now do the actual investment. You now commit the actual money, get your documentation for the commitment of the funds into those investment vehicles, and wait for your returns through other processes. So having invested the money now, It is the duty of the investor. Bear in mind that we talk about the distinction between passive investors and the active investors. Believing that the active investors, they do monitor, they evaluate their investment against the environment, against the indicators of the economy, against the indicators in the specific industry they make investment, against their expectation, whether the investment is performing according to their expectation. And in that investment strategy evaluation and monitoring, provide feedback. And that feedback is an option. And because that feedback provides a lot of option for the investor. That feedback can provide an option for reinvestment plan. That feedback can also provide an option for for the contraction of the investment, disinvestment, expansion of the investment, etc. Reclassification of your investment vehicle. All those things are actually some of the options that will be available after monitoring, evaluation, and feedback from the investment that have been made. And the feedback will determine which option to take. And that is why we normally say an investment actually provide an option, and the option as spelled out already will be undertaken or will be chosen depending on the feedback that the investor receive or the investment manager identifies or receive from the evaluation process. And those that do the evaluation, we refer to them as active investors. But we don't use passive investors loosely, because it does not necessarily mean that the passive investor is an investor who is not interested in monitoring and evaluating his or her investment. But the idea also is that such an investor may merely or virtually be depending on the investment company or the investment manager who he trusts, that he will do all the monitoring, evaluation, the assessment, and do the actual feedback process by actually choosing one of the options available: option to reinvest, option to disinvest, option to reduce the investment, option to expand in a particular investment vehicle, option to actually exit from a particular investment vehicle. You believe that the investment manager will do all that for you, so you become a passive investor. That is one aspect of the passive investor. Of course, it's also true that there are many investors, especially those we call dispersed investors, who are not actually interested in knowing what happens to their investment. They are only expecting the maturity time will come and they will get something. So that distinction is quite important. It is also important to look at the investment process as a virtuous cycle. Virtuous cycle because we believe that the expectation of the investor is favorable. The results are good at the end of the investment. And when that happens, that the investment is performing according to expectation, and then the investment period, the maturity period comes, the investor receives his return, and the investor actually take advantage of any of the options at maturity. So at any point, either at the evaluation stage or at maturity, the investor always has an option. At maturity, the investor has the option to take his investment proceed and consume. At maturity, the investor has the option of taking his investment proceed and reinvest in the same investment, or reinvest in another investment vehicle. The investment, the investor has the option to decide that I will reduce my investment in a particular vehicle. All those options are available to the investor. But so long as the investment is performing, is meeting the investor expectation, and there is the end of one investment, and then at the end of that investment, another investment process starts in that order, then we are talking about a virtuous cycle. So in that case, we are no more looking at investments as an ongoing process or as a continuous process, but it's a continuous process that deliver that follow a virtual cycle. A virtual cycle that you invest at point A, at point B you harvest your investment, and then you at point B again you start another investment, you receive it at the end of point C, and you continue the process. So it becomes a cycle, and because this cycle is beautiful and actually providing what you need, we describe it as a virtuous cycle. So that is about the investment process. Classification of investor based on some characteristics is also very important, except that I want to focus a little bit on the risk averse investor. Risk averse investor is not merely an investor who is not interested in risk taking, not at all. Rather, risk averse investor is the one who is willing to take a minimal risk, but is also willing to take above the average risk because he believes that that extra risk will be compensated for adequately. Now, it is through this behavior of the risk averse investor in which he is willing to take extra risk for extra compensation, which we believe is adequate. That is where we have the principle in finance. We say the higher the risk, the higher the return. So it is not true that the risk averse investor is the investor who doesn't take risk. It's the investor who would take risk, who is rational and would take extra risk because there is an adequate compensation for the extra risk that he has taken. And so it's the behavior of the risk averse investor that define the principle in finance. We say the higher the risk, the higher the return. And this risk averse investor will be seen to influence most of the investment theories that we have looked at already in the course of the session. So that is what we need to appreciate about the risk averse investor. In fact, it is because of this behavior of the risk averse investor that's why we have what we call the reward to risk relationship. Reward to risk relationship. So the risk averse investor is always aligning his reward to his risk. So that is why we have an expression as the expected return minus the risk free divided by the risk, or the standard deviation, which is a measure of total risk here. Uh, the point we're trying to make is that we are expressing the excess return as a ratio of the risk taking. Uh, that is the expression flowing from the investor. So the investor is matching the excess return, that is the compensation, the reward for taking that extra risk. And this can be expressed even when we go to capital asset pricing model. This will be seen as what we call um, the gradient of the security market line. That is if you're using the beta as a sole measure of risk. So that ratio you see, which we call the trainer ratio, is actually an expression of the behavior of the risk averse investor, where we are comparing the excess return to the risk taking. Again, if we are looking at risk from the perspective of Sharpe, where we are looking at Sharpe ratios, because we believe that through portfolio diversification, we are not able to diversify away all the unsystematic risks. Therefore, we are now using the total risk as a measure of risk, or symbolized by the standard deviation. What again we are saying there is that we are actually trying to compare the excess return that the investor receives to the level of risk that he has taken. So we see a reflection of this behavior of the risk averse investor throughout our discussion in the past. So what I want to do finally is just look at the investment manager appraiser. Yes, you have done risk investment policy that you have captured things in. You will need to also appraise the investment manager to see whether he's an investment manager that is performing very well. Is he an investment manager who is actually guided by the investment policy? Do you need to ask him to exit for you to bring another investment manager, or do you want to manage your own investment? But you need to do an appraiser. As an investor, how do you do that appraiser? We just use this simple diagram to do that. So you ask yourself the question: did the manager do what we actually want him to do for us as an investor, or as an institution that have hired the investment company or the investment manager to do for us? If the answer is yes, you then ask yourself, how well did the manager do it? So, did he do it to our appreciation excellently, satisfactorily, averagely? So, how do we score him? If we say no, then you ask yourself, do we want to keep him? The level of his performance, is this something we want to try him again? Now, if we say yes, we want to try him, then the investment manager will stay. But if you say no, then we exit him. But if we go to our first issue from the diagram, if the answer is yes, if we are satisfied with his performance, then there's no reason to change him. So we will keep him. But if we are not satisfied with his performance, we have another option there. The option is to give him another year or another period for him to prove himself better than he did. But if the answer is outright no, then in that case, we ask ourselves if we want to keep him. And if we say no, then we exit him. Now, if we are satisfied of his performance, then we need to ask another question. And that question will be, if his performance is satisfactory, is there any reason to change him? If the answer is yes, that yes, his performance is satisfactory, but there is a reason to change him, then he goes. But if it's no, then he stays. One will be asking, how can an investment manager perform well, yet we have reason to say he should go? Remember, he should be guided by the investment policy. The investment manager may make good benefits or return for the investor, but perhaps that investor is a faith-based investor. It's a sustainable investor, but the investor might not have followed the sustainable rules that the investor prefers, even though returns have been made comfortably. So the investor who is actually sensitive to sustainable investment may say, yes, you have made a good investment return for me, but I don't like the way you don't take instruction. You don't follow the investment policy, so I don't want to keep you. So, but again, if he's unsatisfactory in terms of his performance, and we ask ourselves, do we have to give you another opportunity? And the answer is yes, then he will stay. If the answer is no, we don't want to give you another opportunity, he goes. So whether you answer outrightly no, there are options. If you say yes, there are options. So we need to actually go through this process and take a decision as to how we want to keep or exit the investment manager. So um, I just want to end with the 6 processes of portfolio management. One is you should know the basic principles of finance. 2, you should set your portfolio objectives. 3, you should formulate an investment strategy. Investment should not be done just because you want to do investment. Investment should be guided by some strategy. Have a game plan for portfolio revision. It shouldn't be rigid. It should be open. It should be flexible. If the indicators are there from the economy, from the industry, that there is a need to revise your portfolio, you need to revise the portfolio, because actually at any point in time the investment is an option, and then various options are available for you to explore. Evaluate the performance. Don't allow the investment to go its own way. Continuously evaluate the performance, get feedback, and that feedback should define a set of options for you to choose. Protect the portfolio when appropriate. That is the risk management aspect. You should protect the portfolio when appropriate. Don't allow the portfolio to deteriorate before you come in to intervene. And that is the reason why there is continuous evaluation. That is why the investment is actually a continuous process. It's not a static process, or it's not a static activity. The investment environment, here we want to define two investment environments: the macroeconomic environment and non-macroeconomic environment. The macroeconomic environment, we're talking about inflation, GDP, exchange rate, and the entire fiscal regime within the space you are investing. If these indicators are good, they actually define congenial investment environment. If they are hostile, they define a hostile investment environment. And even though a hostile investment environment may be a good environment for some investors, depending on the area they are operating, but it is acceptable that on average, when these indicators are good, it actually spell out a better environment than when they are volatile. Volatile. Non-macroeconomic environment is also very important for our investment. This will include issues relating to governance indicators. Is the environment governed well? Do we have good regulatory environment? Do we have an environment which is properly regulated? Is corporate governance working well? Corporate governance indicators, are they in place? Do we have property rights? People will be investing not only in financial access, some will be investing in actual real assets. Do we have property rights in the country? Or is it a situation when you invest, somebody will do something, and before you say jack, your investment is gone into the hands of another person? So protection of property rights enshrined in law is part of the non-macroeconomic environment indicators. Ethical behavior of firms. Are firms and their managers minded to manage their firms ethically? Access to electricity, which is basic and very important. Access to telephone and internet and technological devices, overall data and data management within the economy. Security, personal security, security for your investment, are they assured? Investor protection, do we have investor protection existing in law and in big practice? Minority rights as an investor, are they protected? All these things define the macroeconomic environment, and sometimes the non-macroeconomic environment may even be more important than the macroeconomic environment. So we need to bear this in mind. And then, do investors have confidence in the environment? Do your judicial system, does it give confidence to the to the investment environment? Do we have the rule of law in place? All those things will define the investment environment. Do we have a governance and accountability institution? Are they strong? Are they working? Are their views and opinions actually respected? All those things will define the investment environment. So there are many more things. Infrastructure is part of the macroeconomic environment. Infrastructure in terms of roads, IT infrastructure, etc., are very, very important in defining the investment environment. I believe I want to end now finally. Just identify some recent development investment. And this recent development investment are clearly captured in Levy and Post 2005, where Levy and Post 2005 is able to identify 6 recent development in investment where we can add a lot to it. The time that Levy and Post wrote this, many more issues have actually emerged. One is institutionalization of investment. So we see a lot of institutional investment taking place across the globe. Advances in telecommunication and computer technology actually fostering investment across borders and within the country. We also see new investment vehicles and investment strategies actually emerging, and some emerge and become toxic and create financial crisis, etc. But there is a lot of financial innovation, economic or scope taking place relating to the innovation in the financial market, defining many more instruments for investment. So we see the globalization of financial markets actually taking place. We have seen in the past decade mergers and acquisition even of stock exchanges across the globe. So globalization of financial markets take place. And this globalization is good, but also actually changing expectations in terms of international investment because we need to be very careful when we go international. Then they also talk about increased focus on security regulation and investment ethics because in the past 2 decades we have had experience about financial and accounting crisis. We also have financial crisis. We have a debt crisis even in some European countries. All those things affect the workings of financial market and the investment environment. So you see a lot of regulation coming up. We see Sarbanes-Oxley Act came up. We saw the VOCA rules. We saw a lot of regulation changes even in emerging economies because of development across the globe and within their own economies. So all these things actually can be captured as part of the recent development and in investment. So I think we want to end it here. Thank you very much. I will react to your questions when you next send them to me. So if you have any question, don't hesitate to post them to me. Then I'll prepare and discuss them with you. Thank you very much.